What if I told you that the money sitting in your bank account right now isn't actually yours? Not legally. Not when the next crisis hits. And what's coming could make 2008 look like a practice run. Most people have no idea what a bail-in is. They've heard of bailouts, when governments use taxpayer money to rescue failing banks. But a bail-in? That's something entirely different, and it's already written into law in dozens of countries around the world, including the United States. Here's how it works. When a bank fails, instead of the government stepping in with taxpayer money, the bank takes the money directly from depositors. Your savings account, your checking account, your certificates of deposit, all of it becomes fair game to recapitalize the failing institution. You go to sleep with $50,000 in the bank. You wake up with an IOU and maybe some worthless bank shares. Sound far-fetched? It's already happened. Cyprus, 2013. Depositors woke up to find their accounts frozen. When the banks finally reopened, anyone with more than 100,000 euros lost nearly half their money overnight. Poof, gone. Converted to bank equity that became essentially worthless. But here's what nobody talks about. The legal framework for bail-ins isn't some obscure Cypriot law. It's baked into the Dodd-Frank Act in the United States. It's part of the European Union's Bank Recovery and Resolution Directive. The FDIC has explicit authority under Title II of Dodd-Frank to implement bail-ins during systemic crises. Let me read you something directly from an FDIC document. This is public record, but almost nobody has actually read it. The FDIC states that in a resolution scenario, unsecured creditors, and yes, that includes depositors above the insurance limit, would absorb losses. They use the word absorb, like your life savings are just some kind of financial sponge. Now, you might be thinking, I'm insured. I've got FDIC coverage up to $250,000. And you're right, for now. But let's think about what happens in a real systemic crisis. The FDIC's Deposit Insurance Fund currently holds around $125 billion. Sounds like a lot, right? Until you realize that there are over $10 trillion in insured deposits in the United States banking system. Do the math. The FDIC has enough money to cover roughly 1% of insured deposits. 1%. If we see a wave of bank failures, and we're going to talk about why that's increasingly likely, the insurance fund gets depleted almost immediately. Then what? Congress has to appropriate more money. But in a crisis, when the government is already stretched thin, when political gridlock is the norm, how fast do you think that money arrives? And here's the kicker. Even if you're under the insurance limit, bail-ins can still affect you. How? Through something called temporary holds, or haircuts. The bank doesn't technically take your money permanently. They just freeze it. Indefinitely. You can't access it, can't pay your mortgage, can't buy groceries, can't make payroll if you're a business owner. The money exists on paper, but it might as well be on Mars. This isn't conspiracy theory. This is regulatory policy. After the 2008 financial crisis, global regulators decided that taxpayer-funded bailouts were politically untenable, so they created the bail-in framework. The idea was to make sure that bank creditors and depositors, not taxpayers, would bear the cost of future bank failures. It sounds reasonable until you realize that you, the depositor, are now the shock absorber for the entire banking system. Let's talk about why this matters right now, why the risk of bail-ins is higher than it's been in decades. First, the commercial real estate crisis. This is the elephant in the room that mainstream media barely covers. Commercial real estate values have collapsed. Office buildings are sitting empty. Retail spaces are ghost towns. And who holds most of the debt on these properties? Regional and community banks. We're talking about hundreds of billions of dollars in loans that are underwater. When these loans default, and they are defaulting, banks take massive losses. Their capital ratios deteriorate. They become vulnerable. And when banks become vulnerable, the bail-in framework activates. It's not a question of if, it's a question of when. Second, the bond market bloodbath. Banks hold enormous portfolios of government bonds and mortgage-backed securities. When interest rates spiked, the value of these bonds plummeted. Silicon Valley Bank failed in part because of unrealized losses on its bond portfolio. When depositors got spooked and started withdrawing money, the bank had to sell those bonds at a loss. That crystallized the losses and destroyed the bank's capital. Silicon Valley Bank wasn't unique. It was just the first domino. Look at the balance sheets of regional banks across the country. They're sitting on hundreds of billions in unrealized losses. As long as they don't have to sell those bonds, they can pretend everything is fine. But the moment there's a run, the moment depositors get nervous and start pulling money out, those banks are forced to realize those losses. And then the bail-in provisions kick in. Third, the derivatives time bomb. The global derivatives market is estimated at over $600 trillion in notional value. $600 trillion. That's more than 7 times global GDP. These are complex financial instruments that banks use to hedge risk, but they also create massive interconnected exposures. When one major institution fails, it can trigger a cascade of derivative contract failures across the entire system. In a derivatives crisis, banks don't fail one at a time. They fail in clusters, and when that happens, the FDIC doesn't have the resources to handle it. The bail-in framework becomes the only option. Your deposits become the firewall. Now, let's talk about what's happening with gold, because while all of this is unfolding, something remarkable is taking place in the gold market, something that tells you exactly what the smart money is doing. Central banks are buying gold at a pace we haven't seen in over 50 years. According to recent data, central banks purchased over 1,000 tons of gold in a single year. That's the highest level since the early 1970s, right before the last major monetary crisis. Who's buying? China, Russia, India, Turkey, Poland, Singapore. Even countries that traditionally held mostly dollars are diversifying into gold. Why? Because they see what's coming. They understand that the dollar-based system is under stress. They're preparing for a world where dollars might not be as safe or as valuable as they once were. China's been particularly aggressive. Official numbers show they've added hundreds of tons to their reserves, but many analysts believe the real number is much higher. China has a history of underreporting gold purchases and then revealing the true figures years later. They're accumulating quietly, not wanting to spook the market or tip off competitors. And it's not just central banks. Look at what's happening with BRICS nations. Brazil, Russia, India, China, South Africa. They're actively working to reduce their dependence on the dollar. They're settling trade in local currencies. They're exploring a gold-backed trade currency. The so-called unit that's been discussed would be partially backed by gold, creating an alternative to dollar-based settlement. This is de-dollarization in real time, and when countries move away from the dollar, they move toward gold. It's the only asset with no counterparty risk. It's the only asset that every country recognizes as valuable. It's the ultimate neutral reserve asset. Here's what's fascinating. While central banks are buying, Western investors have been largely absent. Gold ETF holdings actually declined over the past couple of years. Retail investors in the United States and Europe have been more interested in stocks and crypto. They've ignored gold. But that's changing. As the banking stress becomes more visible, as people start to understand the bail-in risk, gold demand is surging. The price recently broke through $3,900 per ounce. That's a record high. And the technical setup suggests we're just getting started. Look at the chart. Gold spent years consolidating between $1,800 and $2,000. That was a massive base-building pattern. When it finally broke out above $2,000, it signaled the start of a new bull market. Every pullback since then has been bought aggressively. The trend is unmistakably higher. But here's what most people miss. The gold price you see quoted, that's the paper price. That's the price of gold futures contracts and ETFs. The physical market is telling a different story. Premiums on physical gold coins and bars have exploded. In some cases, you're paying 5 to 10% over the spot price just to get your hands on actual metal. Why? Because there's a shortage. Mints can't keep up with demand. Dealers are running low on inventory. And when you try to buy in size, let's say 100 ounces or more, good luck finding it at anywhere near spot price. The physical market is tight. And when physical markets get tight, prices eventually have to rise to reflect that reality. Now, think about what this means for you. If you're sitting on cash in a bank account, you're exposed to bail-in risk. You're exposed to inflation. You're exposed to currency debasement, and you're earning essentially nothing in interest. Gold, on the other hand, has no counterparty risk. It can't be bailed in. It can't be frozen. It can't be confiscated through some regulatory sleight of hand. It's yours, completely. And historically, it's preserved purchasing power through every major monetary crisis. Let me give you a historical parallel. In the 1970s, the United States faced a similar crisis of confidence in the banking system and the dollar. Inflation was raging. The dollar had been devalued. Banks were failing. And gold went from $35 an ounce to over $800. That's more than a 20-fold increase in less than a decade. We're seeing similar dynamics today. Massive government debt, central banks printing money, banking system stress, currency debasement. The ingredients are all there for another major gold bull market, and we're still in the early innings. Here's something else to consider. If you have significant retirement savings, let's say $100,000 or more in an IRA or 401k, there's a way to get physical gold into those accounts without triggering taxes or penalties. It's called a gold IRA. I put together a free guide that walks through exactly how it works, what the rules are, and how to set it up properly. You'll find that in the description below. It's worth looking into if you want to protect retirement savings from the risks we're discussing. The point is, you have options. You don't have to sit there and hope your bank stays solvent. You don't have to trust that the FDIC will be able to cover your deposits in a systemic crisis. You can take action now, while there's still time. Let's talk about the mechanics of a bail-in scenario, because understanding how this actually unfolds is crucial. It doesn't happen overnight. There's a sequence of events. First, you get warning signs. Bank stocks start falling. Credit default swaps, which are essentially insurance against bank failures, start widening. Analysts start whispering about balance sheet problems, but most people ignore these signals. They think, it won't happen to my bank. Then you get the trigger event. Maybe it's a major commercial real estate default. Maybe it's a derivatives blowup. Maybe it's a geopolitical shock that causes a flight to safety. Whatever it is, it causes depositors to get nervous. Once people get nervous, they start withdrawing money. Not everyone at once, just enough to create pressure. The bank has to meet those withdrawals, which means selling assets. But remember, many of those assets are underwater. Selling them crystallizes losses. The bank's capital position deteriorates. At some point, regulators step in. They declare the bank critically undercapitalized. They invoke resolution authority. And here's where it gets scary. They do this over a weekend. Friday, your bank is open for business. Monday morning, it's in resolution. Your accounts are frozen. You can't access your money. The regulators then implement the bail-in. They convert a portion of deposits above the insurance limit into equity. They might impose haircuts on all deposits. They might create a good bank and a bad bank, with your money stuck in the bad bank while they sort things out. This process can take months, sometimes years. During this time, you're in limbo. You might get some of your money back eventually. But you might not. And even if you do, the purchasing power of that money might be significantly diminished due to inflation or currency devaluation. This is why gold is so important. It's outside the banking system. It's not subject to bail-ins. It's not dependent on any institution's solvency. It's pure financial insurance. Now, some people will say, but gold doesn't pay interest. It just sits there. That's true. Gold doesn't generate yield. But here's the question you need to ask. Would you rather have an asset that pays 2% interest but carries bail-in risk, inflation risk, and counterparty risk? Or would you rather have an asset that pays no interest but preserves your wealth and carries zero counterparty risk? In a stable environment, maybe you take the yield. But we're not in a stable environment. We're in an environment where the risks are asymmetric. The downside of being in the banking system is catastrophic. The downside of holding gold is opportunity cost. Those aren't equivalent risks. Let's also talk about the supply side of gold, because this is another factor driving prices higher. Gold production has been essentially flat for years. The easy gold has been mined. New discoveries are rare, and the cost of production keeps rising. Energy costs, labor costs, regulatory costs, all of these make it more expensive to pull gold out of the ground. Meanwhile, demand is surging. Central banks are buying. Asian consumers are buying. Investors are buying. And industrial demand for gold in electronics and other applications continues to grow. You have flat supply and rising demand. Economics 101 tells you what happens next. There's also the geopolitical dimension. As tensions rise between the United States and China, between the West and Russia, between various regional powers, gold becomes more important. It's the neutral asset. It's the asset that doesn't depend on any single country's stability or any single currency's value. In a multipolar world, gold is the ultimate reserve asset. Think about what happened when Russia was hit with sanctions. Western countries froze Russian central bank reserves held in dollars and euros, hundreds of billions of dollars, just frozen, inaccessible. That sent shockwaves through the global financial system. Every country with significant dollar reserves started thinking, could that happen to us? The answer is yes, it could, and that's why they're diversifying into gold. Gold can't be frozen. It can't be sanctioned. If you hold physical gold in your own vaults, it's yours. Period. No one can take it away with the stroke of a pen. This is the new reality of the global financial system. Trust is eroding. The dollar's dominance is being questioned, and gold is reasserting itself as the ultimate form of money. Let me give you another historical example. In 1933, during the Great Depression, the U.S. government confiscated gold from private citizens. Executive Order 6102 required Americans to turn in their gold coins, bars, and certificates in exchange for dollars at a fixed price. Those who refused faced fines and imprisonment. Why did they do this? Because the government wanted to devalue the dollar against gold. They wanted to inflate the money supply to fight deflation. But they couldn't do that effectively if citizens were hoarding gold. So they confiscated it. After the confiscation, the government revalued gold from $20 an ounce to $35 an ounce. That was a 40% devaluation of the dollar overnight. Anyone who had turned in their gold at $20 lost that 40%. Anyone who had managed to keep their gold, and some people did, saw their wealth increase by 40%. Now, I'm not saying gold confiscation is likely today. The circumstances are different. But the lesson is clear. In times of monetary crisis, governments do desperate things. They change the rules. They confiscate assets. They impose capital controls. And if you're caught unprepared, you suffer the consequences. Gold is your hedge against that kind of government action. It's your hedge against monetary chaos. It's your hedge against the bail-in framework that's already in place and waiting to be activated. Here's what you need to understand about the current moment. We're at an inflection point. The banking system is under stress. The monetary system is under stress. Geopolitical tensions are rising. And the tools that governments use to manage previous crises, bailouts, money printing, zero interest rates, are either politically unacceptable or economically ineffective. That leaves bail-ins. That leaves depositor haircuts. That leaves the confiscation of wealth from savers to prop up failing institutions. And that leaves gold as one of the few safe havens. The smart money knows this. That's why central banks are buying. That's why billionaires are buying. That's why family offices are allocating significant portions of their portfolios to physical gold. They're not doing this because they think gold is going to double next week. They're doing it because they understand the risks in the system and they want insurance. You should be thinking the same way. This isn't about speculation. This isn't about trying to time the market perfectly. This is about protection. This is about making sure that when the next crisis hits, and it will hit, you're not the one left holding the bag. Let me paint you a picture of what the next crisis might look like. It starts with a major bank failure, not a small regional bank, a systemically important institution, the kind of bank that's too big to fail. Except this time, the political will for a bailout isn't there. The public is angry, Congress is gridlocked, and regulators decide to implement a bail-in. Overnight, billions of dollars in deposits are converted to equity or simply frozen. Panic spreads. Depositors at other banks start withdrawing money. The contagion spreads. More banks fail. More bail-ins are implemented. The stock market crashes. Credit markets freeze. The economy grinds to a halt. In this scenario, what happens to gold? It skyrockets. Because suddenly, everyone realizes that the only safe asset is the one with no counterparty risk. The only safe asset is the one that can't be bailed in. The only safe asset is gold. We saw a preview of this in March of 2023 when Silicon Valley Bank failed. Gold spiked. It jumped $200 in a matter of days. And that was just one bank. Imagine what happens when multiple banks fail simultaneously. The price of gold could easily double or triple in a short period of time. We've seen it happen before. In 2008, gold went from $700 to $1,900 in just 3 years. In the 1970s, as I mentioned, it went up more than 20-fold. The potential is there. The fundamentals are there. The catalyst is coming. But here's the thing. You can't wait until the crisis hits to buy gold. By then, it's too late. Premiums will be astronomical. Availability will be scarce. You'll be competing with millions of other people who suddenly realized they need protection. The time to buy gold is now, while it's still available at reasonable prices. Think of it like insurance. You don't buy fire insurance after your house is already burning. You buy it beforehand when everything seems fine. Gold is financial fire insurance. And right now, the house isn't burning yet, but you can smell the smoke. Let's also address a common objection. Some people say, gold is too expensive. It's at all-time highs. I'll wait for a pullback. Here's the problem with that thinking. Yes, gold is at all-time highs in nominal terms. But in real terms, adjusted for inflation, it's still well below its 1980 peak. In 1980, gold hit $850. Adjusted for inflation, that's over $3,000 in today's money. We're barely above that level now. Moreover, when you're buying gold as insurance, the price is almost irrelevant. You're not trying to time the bottom. You're trying to protect yourself from catastrophic risk. If gold goes to $5,000 or $10,000 because the banking system collapses, does it really matter whether you bought at $3,000 or $3,500? The point is to have the insurance in place before you need it. The point is to have a portion of your wealth outside the banking system, outside the reach of bail-ins and government confiscation, outside the realm of counterparty risk. Here's another angle to consider: the debt situation. The United States has over $34 trillion in national debt. That number is growing by trillions every year. Interest payments on that debt are now over $1 trillion annually. That's more than the defense budget. It's unsustainable. At some point, something has to give. Either the government defaults, which would be catastrophic, or they inflate the debt away, which means printing massive amounts of money and devaluing the currency. Either scenario is bullish for gold. If they default, gold becomes the safe haven as confidence in government bonds evaporates. If they inflate, gold preserves purchasing power as the currency loses value. Heads, gold wins. Tails, gold wins. There's no scenario where the current debt trajectory continues indefinitely without consequences, and in every consequence scenario, gold benefits. The same logic applies globally. Japan has debt to GDP over 250%. Europe is drowning in debt. China has hidden debt in local governments and state-owned enterprises that could be in the tens of trillions. This is a global debt crisis waiting to happen, and when it does, gold will be the asset everyone wants. Now let's talk about practical steps. If you're convinced that bail-in risk is real and that gold is the solution, what do you actually do? First, assess your exposure. How much money do you have in banks? Is it above the FDIC insurance limit? Are you concentrated in one institution or spread across multiple banks? Understanding your current risk is the first step. Second, decide on your allocation. Financial advisors traditionally recommended 5 to 10% of a portfolio in gold, but given the current risks, many are now recommending 20 to 30% or even higher. The right allocation depends on your individual circumstances, but the key is to have enough that it makes a difference if things go wrong. Third, decide on the form. Physical gold, coins, and bars is the purest form of ownership. You hold it, you control it. No counterparty risk, but it requires secure storage. Gold ETFs are more convenient, but introduce counterparty risk. You're trusting the fund to actually hold the gold. Gold mining stocks offer leverage to the gold price, but come with company-specific risks. Each has pros and cons. For most people, a combination makes sense. Some physical gold for ultimate security, maybe some in a gold IRA for retirement accounts, perhaps some mining stocks for growth potential. Diversification within your gold allocation. Fourth, act. Don't procrastinate. Don't wait for the perfect moment. The perfect moment is now, before the crisis hits. Start building your position. You can dollar cost average if you're worried about timing. Buy a little each month, but start. The bail-in framework is real. It's in place. It's waiting to be activated. And when the next crisis comes, and it's coming, you don't want to be caught unprepared. You don't want to be the person who wakes up to find their bank account frozen and their life savings converted to worthless bank equity. Gold is your protection. Gold is your insurance. Gold is your way out of the banking system and into true financial security. The central banks know it. The billionaires know it. The question is, do you know it? And more importantly, are you going to act on it? The warning signs are everywhere. The commercial real estate crisis, the bond market losses, the derivatives exposure, the unsustainable debt, the geopolitical tensions, the de-dollarization trend. All of it points to the same conclusion. The current system is unstable, and when it breaks, gold will be the asset that preserves wealth. Don't wait until it's too late. Don't wait until the bail-ins start. Don't wait until gold is $5,000 an ounce and unavailable at any price. Take action now. Protect yourself. Protect your family. Protect your future. The bail-in is coming. The only question is whether you'll be ready.